Hi, the video that you're about to watch is a recording of a free educational webinar that we at Bloomfield Financial put on at regular intervals. If you'd be interested in attending future webinars, you can sign up for them at bloomfieldfinancial.co.uk/webinars. And if, when you review the list, there isn't anything that appeals to you, you'd like to be notified of new webinars, pop your details in and we'll drop you an email when we add to the list. Please bear in mind when watching the webinar that it was recorded in the past and the information may become out of date over time. At the time of uploading, it's still accurate and the date of the presentation is on the webinar itself. We don't upload every webinar that we present because it may be more likely to become out of date quickly. So if you would like to attend a webinar, please feel free to register. And if you can't attend, register anyway and you'll get a recording of the webinar that'll stay up for a few days if it is a time-sensitive matter or something that's likely to become out of date relatively quickly. If you have any queries, questions, please, as always, don't take these videos as personalised independent financial advice. Seek out a financial advisor to get the advice that you require, and please feel free to contact us.
Okay, so it's 10 o'clock, so just get started straight away. Aim is to sort of keep the presentation to 30 to 45 minutes to allow a bit of time for questions and things at the end, if there are any. Software we use means that if you submit a question via the question and answer, it's anonymous, nobody else can see it. It'll come directly to us in the same way that nobody else can see who's logged in other than myself and Dee, assuming we've set it up correctly. This is the only second time we've used this software, so at the end there'll be a survey to ask you any questions about how you found using the software, etc. So any feedback you have on that would be gratefully received. So the pensions annual allowance, if you're here, you probably know what that is, but I will start with a bit of background on the allowance. Firstly, when you join, you should be automatically muted, but if you could stay muted, that would be great. I'll have my speakers turned off throughout so that if somebody does accidentally unmute themselves, there's no feedback loop. So if somebody needs to let me know that something's happening like that, if you press the emoticon thing at the bottom of the screen to let me know that something's happening, I'll have a look. But Dee's also got access to control those sort of things if something happens. Questions and answers. Questions can be asked in the Q&A box at the bottom of the screen. In the middle, it looks like a speech bubble with a question mark in it. As I say, those will come through to me and Dee, but they won't be visible to everybody else. I'll try and cover everything I can at the end of the webinar, if I haven't already covered it in the webinar. And if I don't, I will do a tack on to the recording to cover it then. The recording will be available before the end of the day, but it'll probably only be available for a limited period of time. Essentially, these things become out of date. So we're kind of reluctant to just throw them up on YouTube or whatever without having checked them out with compliance things first. So some will be available for longer than others, depending on the subject matter and how time sensitive it is. And again, just to emphasize that the webinar is considered educational and is not personal advice. Usual investment warnings. Not that we're really going to talk about investments during this, but past performance is not a reliable indicator of future results, and the value of investments and the income from them can rise and fall. Capital is at risk. Again, this one specifically in this seminar, we can't accept reliability for calculations carried out using the methods that we're going to describe. Here, there might be nuances, little bits and pieces that are very unusual, so we won't necessarily cover them here. Consult the rules which are on HMRC's website or a professional if you have doubts over your own position. But hopefully, after we cover what we cover in the webinar, you should know whether you really need to get involved with a professional or not. So we'll cover what the annual allowance actually is, how to calculate your personal annual allowance, what happens if you exceed the annual allowance, and reasons that exceeding the allowance might be a good idea in certain circumstances, and then Q&A. So the background to the pensions annual allowance. So you can pay as much as you want into a pension scheme every year. There is no limit on what you can pay in. What the annual allowance limits is how much of what you pay in can be tax relievable. how much can go in gross, basically. If you go over the allowance, you get a clawback known as the annual allowance charge. It's not a penalty. There's no punitive element to it. It's simply recovering the tax that you should have paid if the money hadn't gone into a pension, although the money itself can stay in the pension afterwards. Why does such a thing exist in the first place? It's very complicated and often affects people who aren't necessarily the target of it. But essentially, pensions are the most tax efficient investment vehicle that we have, by a long way. And there was concern, particularly when pension freedoms came in, that the extremely wealthy might use pensions as a way of avoiding income tax, possibly all income tax, and getting around inheritance tax in a significant way. So allowance, like annual allowance and lifetime allowance, were brought in to try and make that less attractive for the super wealthy to do. So there is a standard allowance, which is £60,000 in this current tax year. So that's £60,000 gross that can go into your pension and get tax relief if you're subject to the standard allowance. But quite often, it's not the allowance that's actually available to you as an individual. And that applies to both high and low earners, as there are a few nuances that determine what allowance is your personal allowance. Your allowance could be capped, it could be tapered, or you could be subject to the money purchase annual allowance, and you might have carry forward available to increase your allowance. So calculating your personal number is a series of questions to ask to get to where you need to be, which hopefully this process will cover. So working out your personal allowance, the first question you have to ask is, do you have an earned UK income? And if the answer is no, then it's really simple. You can pay £3,600 gross per year into a pension. And that was brought in with the stakeholder regulations. It's not really part of the annual allowance, but effectively it's how much you can pay in and get tax relief if you have no earned UK income. But if you have UK income, then you have to ask, have you accessed any pensions flexibly? Now, if you're under 55, then the answer to that should be no. Fairly straightforward. What flexible access means, have you taken any benefits from a money purchase pension? That's one where you save up a pot of money, as opposed to a defined benefits pension where you get a promise to pay, like the NHS scheme or final salary scheme. That's classed as flexible. Typically, that means have you gone into drawdown, but it also could mean that you've had a variable income annuity that has an underlying investment element to it. If the answer to that is yes, then you have an annual allowance of £10,000. The MPAA is the money purchase annual allowance. Now, this only applies to defined contribution pensions, the ones where you're putting money in and building up a pot of money that you're going to draw from. If you're also a member of something like a final salary scheme, like the NHS scheme or the civil service scheme, or ones that exist in some companies, that's not affected by the money purchase annual allowance. You still have whatever's left over, so £50,000, the current allowance, towards those schemes, because the allowance is designed to prevent people amassing wealth in defined contribution schemes to avoid tax and avoid inheritance tax. You can't really do that in the defined pension scheme, so it's not applied to that. If you haven't accessed any flexible benefits, then the question becomes, do you earn more than £60,000 per year? So something where people often fall down and think they've accessed flexible benefits, but they haven't, is if they've taken the tax-free cash from a pension scheme. If you've taken the tax-free cash and bought a normal annuity, or you've taken the tax-free cash and put the rest into drawdown, but not actually drawn anything out of the pension scheme, then you haven't accessed flexible benefits. Tax-free cash on its own is classed as a taxable benefit, as a flexible benefit. So the money purchase annual allowance, which I mentioned before, that limits your contributions to £10,000 or your total earnings of less. So if you earn £8,000, then it's limited to £8,000. It only applies to defined contribution pension schemes, I've already mentioned, and you can still contribute to defined benefit pension schemes. Obviously, there should be schemes. It's designed to limit pension recycling. So it's meant to prevent you from drawing off an income from a pension every month, but just paying that into another pension in order to get a tax rebate. It comes into effect the day after you take your flexible benefits. So if you had a lump sum you wanted to pay in, if you paid in the day before, it wouldn't matter. So then we have your personal allowance. So back to the questions. Do you earn more than £60,000? If the answer is no, then your annual allowance is 100% of your earnings. This is obviously assuming you've got no carry forward, which we'll cover later. So if you earn £50,000, the most you can pay in is £50,000. If you earn £40,000, the most you can pay in is £40,000. If you earn more than £60,000, then it gets a bit more complicated. We have to start asking, will you be tapered? If the answer is no, then your limit is £60,000, the standard lifetime allowance. But for high earners, it can be reduced. Basically meant to stop high earners from abusing pensions to gain high amounts of tax relief. Basically, the government will reduce your annual allowance available if income passes two levels, known as the threshold income, which is currently $200,000, and the adjusted income, which is $260,000. It was different levels in different tax years, and if you're working out past allowances, for different years, you use the threshold and the adjusted income levels as they were in those years. Essentially, if you go over the adjusted income level, every £2 you go over, you lose £1 of your annual allowance until you reach the minimum of £10,000. You can't go below £10,000. You'll always be left with a £10,000 annual allowance. So the first step in working out if you're going to be tapered is working out your threshold income. And are you going to go over that £200,000 in the calculation? So to work out both types of income, you start off with net income. So this is basically your taxable UK income. So it's earnings from employment, earnings from self-employment, dividends, interest on savings, interest from shares, income received from a trust. The name that's used in the calculations from HMRC net income is a bit misleading because it's actually amounts before tax, not the amounts after. You do get to deduct any tax reliefs for personal pension contributions. There's some other nuances of things that qualify, but mainly it's a personal pension contribution. So if you've made a contribution outside of your workplace scheme, you get to deduct that off your net income for the calculation for threshold income. So you get to deduct relief at source pension contributions made through work. So a relief at source contribution is if your workplace deducts your pension contribution after tax has been deducted, and then your pension scheme claims back the basic tax. That is considered a relief at source contribution, and similar to personal contributions, you can deduct that from your net income as part of the threshold calculation. Start with net income, take that off. So then you add on to the figure any salary reductions in exchange for pension. So salary exchange. So if you're deducting salary exchange in £5,000 a year, you add £5,000 on to your net income figure after deducting those sort of things if they apply, which they probably wouldn't if you were in a salary exchange. And then you can deduct any pension death benefits received. Now that's pretty unusual because essentially that means somebody close to you died, just to make sure they're not taken into account. So if your net income, after you do this calculation, is under £200,000, the threshold for this year, then you don't need to calculate your adjusted income, and your annual allowance is the standard £60,000. You have to pass both the threshold income and the adjusted income level in order to have a reduction. Both have to be exceeded. So if you do this one first, which is the order you expected to do them in, which is why it's called threshold, and it comes out on a 200,000, you don't have to bother doing the next one. So calculating your adjusted income. This is the calculation that's done in order to establish how much they're going to reduce your annual allowance by, if it's going to happen at all. So again, we start off with the net income figure, which is worked out in the same way as it was before. So it's all your taxable income for the tax year, take off anything with that was tax relievable, which is generally personal pension contributions, but there are a few other things that can go into that. So once you've got your net income, you add back on any tax relief claims for pension savings, personal or third-party payments, etc. So what you just took off to get to net income, you add back on again here. Then you add pension contributions made before tax deduction, basically pension contributions you made at work where it's not a relief and source scheme. If you're non-dom, then you add on any relief claimed on overseas pensions. And then you add on any employer's pension contributions. And then you can deduct again any lump sum death benefits received from pension schemes. So this is going to come out as a higher figure. If the amount was less than 260,000, which is the current adjusted income, I obviously haven't typed that correctly on there, I should say calculate an adjusted income, less than 260,000, then you will have a standard annual allowance of £60,000. If you go over, for every £2 in excess, the annual allowance is reduced by £1 up until an income of 360,000. So if it comes out at 360,000, that's £100,000 over the current threshold. So you'll lose £50,000 worth of your allowance, taking you down to the £10,000 minimum. Anything above 360,000, it doesn't matter. You're still blocked at the £10,000 under the current rules. So a quick example. I don't know why it's called Jethro, just want to type that there. So in this example, his income is a salary of 180,000. He has £10,000 in dividends that he gets. And his pension payments, he has £20,000 going into a salary exchange pension scheme, 5k, which is what he gives up, £15,000 is what the company's giving him. He pays £8,000 personally into a SIP. And because that goes in from his own pocket, from his own bank account, it gets an instant £2,000 relief claimed by the scheme, and he would claim the further relief on his self-assessment tax return. So Jethro's threshold income for the year is going to be £185,000. So that's his £180,000 salary, plus his dividends, plus the £5,000 he's personally giving up to go into his salary exchange pension scheme. Take away the £10,000 personal calculation, personal contribution to his SIP. His adjusted income, there's no calculation required because his threshold income is below the £200,000. So the standard annual allowance would apply. But if his dividends grew and he stopped paying into his SIP, so this scenario raises threshold income to 225,000. So he's got his £180,000 salary. He's now got £20,000 worth of dividends rather than the 10. He's also had a £20,000 bonus. And he's still paying his £5,000 of his salary exchange pension. So 225,000. So he has to calculate his adjusted income, which comes out at 240,000. So he's got his £180,000 salary, 20k dividends, 20k bonus, and his total employer pension contributions of £20,000. So his £5,000 already factored in the here. That comes out at 240. It's under the 260. So he's got no reduction in his annual allowance. If you play around with the calculations, it's really difficult to stay under the threshold income level, but be over the adjusted income level. So as in be above this, where you should have had it reduced, but have this below 200,000, so you never have to do this calculation in the first place. But there is one exception, and we see this as an executive pension, executive salary and remuneration packages. So it's basically high employer non-contributory pensions. So if we take them back to where we were before with this threshold income of 185, so 180k salary, 10k dividends, £5,000 per salary exchange, £10,000 personal SIP calculation, and we can give them an adjusted income of 390,000. So 180 grand salary, £10,000 dividends, £200,000 total employer pension contributions. It would never get his annual allowance reduced because this didn't pass the threshold, so this was never required to be calculated. Now, obviously, 200,000 is an extreme example. But what we sometimes see is that when people get to a certain level in a company or certain company pension schemes organisation, what is offered an annual salary review for the employee is that instead of them paying into a pension scheme themselves, they can have a non-contributory company pension scheme of £60,000 per year. So the company will pay £5,000 in a month, £60,000 a year, the annual allowance. Essentially, the employee stops paying into the pension scheme, and if they're around the right level, it might stop them going over the threshold income, so they never have their annual allowance reduced. Now, it's a tricky one from a company to organise. Generally, it requires that you have an annual remuneration review, which it's re-agreed. And if your income naturally pushes over the 200,000, so you have to be assessed anyway, then it won't help, because you can't really go back on it because you've gone over that threshold unless you have an annual salary and remuneration package reviews. So that tends to be when people are on short-term contracts, which happens with C-level executives a lot of the time. But you can't really make a decision halfway through the year or wherever to give up a load of salary in exchange for a load of pension, because that would be considered salary exchange, which would be added in this calculation in the first place and catch you out. So that's why it has to be part of a non-contributory pension usually, or the contributions doesn't have to be dependent on what the employee gives up. And it's normally agreed as part of an overall remuneration package, either initially or annually, in order to ensure that it's not considered to be salary that was exchanged. Now, if after doing the calculations, then you need to know if you've gone over. So then you have to establish what your pension contributions have been worth. So for defined contribution pensions, it's pretty simple. It's just how much did you pay in the tax year. So you can work it out by looking at your contribution history. You can ask the pension schemes for the pension input amount. It's fairly straightforward. So just to remind, a defined contribution pension scheme is what the majority of people have, where you're putting your money into a pot, it has a value, it goes up. When you get to retirement, you use that value to provide yourself with a pension via various means. A defined benefits pension is the opposite, where it's normally called final salary or career averaged earnings, where your pension at the end is determined by how much you've earned during your career and how long you worked at the company. You do pay contributions towards it, but they don't define what you get back at the end. For defined benefit pensions, it's more complex in working out what your level of contribution has been as far as the annual allowance is concerned. There's a calculation on HMRC's website, which I'm not going to go into details, but essentially you have to quantify how much your pension is worth at the beginning of the tax year, and then quantify how much it's worth at the end of the tax year, and the difference is how much your contributions have been from an annual allowance perspective. Now, it's a complicated calculation, but you will find most pension schemes, if you ring them up, if you are a defined benefit pension scheme member, and you simply ask them for your pension input amount for X tax year or X period, because they can have pension input periods that don't label the tax year in very rare circumstances. Most are aligned. They can just give you the number. Where they struggle is in the current tax year, because there is a factor in there for inflation. So if you're trying to work something out in the current tax year and you've got a defined benefit pension, you probably do need to sit down with professional, and even they will only be able to get you an estimate because it depends on what inflation turns out across the year. Again, just ask for the pension input amount if you're looking for past years. If you've established how much you've got going in and you've gone over, then you look at, do you have any carry forward available? So carry forward is the concept that if in previous tax years you haven't used all of your annual allowance, then you may be able to bring some of it forward if you've gone over in the current tax year. So it's only if you've used all of the current year's allowance. This is something people often get tripped up on. They think that if they've got a £60,000 allowance, they're paying £90,000 in, and that they can use the 60,000 they didn't use from last year and then 30,000 of this year's. It doesn't work that way. You have to use up all of this year's allowance before you can invoke any of the previous years for carry forward. You have to have been a member of a pension scheme in the previous years. You don't have to have been paying in, you just have to have been a member. So this is designed to stop, essentially, again, people with a lot of money opening a pension scheme and trying to use several years' allowance as part of their family's tax planning when they didn't actually have pension previously. If they're 21, just getting started, that sort of thing. But granddad needs to get rid of a lot of money. That's what that's there for. You can use allowances from up to the last 3 tax years. If you're subject to the money purchase annual allowance, which if you remember, this is when you've accessed benefits flexibly, you cannot carry forward anything. So here's a worked example for somebody who's earning 80k. And let's just say they have been throughout. So in year 1, 2021, 2022, they had a 40,000 allowance because that was the allowance back then. And they used 20k and they left 20k left over. So again, 2023, the leftover was 5k. 2024, they had 25 grand left. And so far in this tax year, which should say 2024, 2025, a lot of typos in this one, they've used 15k, so they've got 45 grand left. So they've got £50,000 of unused allowance for those previous years. That's in theory available for carry forward. So with that 50k plus the 45, then they would have a 95k allowance. Not 90 is written there, but they haven't because it's capped at 80k, because it's capped at their total earnings for the year. So they would have 65k that they could left paying in because they've already used 15, sorry. So even if you've got lots of carry forward, you're still always capped by your salary for the year. And when you're using the carry forward, the earliest year would be used first. So in this case, if he was going to pay the full 80k across the whole year, so he's going to use 60 from this year and then 20 further, it will be the 20 from 2021, 22 that was used. So next year, that 5 and 25 would still be available. What happens if you have gone over? Well, you have to tell HMRC yourself. It's normally via your self-assessment. Depending on how your form comes up and how your pension is structured, you might have to do it via the extra information box at the end, which often trips people up. HMRC will pick up on it eventually, but it's better to tell them in the year that it actually happened if you know it's happened, because they don't pick up on it instantly. It takes them a while, and if it takes them a while, it can cause problems because they're coordinating pension information from your employer, pension information from you. The systems don't talk to each other as well as they ideally would. If you don't do a self-assessment, you can write to them and let them know that this has happened so that they can issue you the correct charge. If you have an accountant, make sure you count it out. If you think you might have gone over or you might be subject to the money purchase annual allowance, I have never come across an accountant who checks these things by default. Sometimes they'll come to people like us and ask us to calculate them for them when it comes up, but by default, they don't normally check. If you're going to tell HMRC by self-assessment or via a letter or via your accountant, I would strongly recommend that you calculate your own charge. When you tell them, give them a breakdown of your carry forward, how you've worked it out and what you think your charge is. They will generally agree with you and issue the charge, annual allowance excess charge based upon your calculation. The fact you've supplied them with the calculation gives you some protection in the future should anybody ever say that you've tried to mislead because you've revealed your work. And basically, if you are using carry forward again, to a point that you don't need to tell them you've gone over because you know the carry forward is covering everything, keep a record of your calculation, save it on your computer, save it on your phone, wherever you can keep it forever, just so if you are asked, because the systems pick up that you've gone over the annual allowance and then not noticing what carry forward you've got, you need to be able to show them why you believe that you hadn't gone over. So the excess annual allowance charge is simply tax reclaim. It's not a penalty. So people are often quite afraid of it, but it's not a penalty. It's just taking back the cash, the tax that you should have paid. So it's not trying to leave you in a worse position than you would have been if you just not received the tax relief in the first place. And it's based upon your tax code, tax rate, highest tax rate at the time. So basic rate, high rate, additional rate, just sticking with the English ones for simplicity. So if you've gone over by 10 grand, you pay 2 grand if you're basic rate taxpayer, 4 grand if you're a high rate taxpayer, 4.5 if you're additional rate taxpayer, and so on. But how do you actually pay the charge? So there's something called voluntary scheme pays, and not all pension schemes offer this. Essentially, you've accrued a charge, you know what the charge is, and HMRC will issue you a charge notice to ask you for their money. You can then contact your pension scheme, ask them to pay the charge from the pot of money, rather than you having to get it from your bank account, as it were. Now, this is one of the reasons why you need to tell HMRC if you've gone over in the year you've gone over, because most schemes will only pay for the charge based on the most recent period that can be issued a charge for. So there's quite a lag between when you pay the charge and when the charge is incurred, because of the way the tax system works. You file your self-assessment return, but you don't have to pay the tax till January. Depends on how long it takes to issue the bill. Now, if it goes beyond that period, the scheme has concerns that you've deliberately avoided it, deliberately evaded it. It can become much more complicated. They don't want to get into issues where they might be forced to calculate how much you've made from that scenario, etc. So generally speaking, they will only pay them from the current period. If you know you're going to go over, it's worth contacting your scheme just to make sure that the offer voluntary scheme pays at all, because it is voluntary. They can use the rules of the scheme to avoid paying it under some circumstances. So not all work schemes offer it, for example. So if you think you might go over, then check with your scheme, check with your HR department, etc. And if it's a personal scheme, again, check with the scheme. Something worth noting as well is if you go over and then you transfer the money to a new pension scheme, the new pension scheme doesn't have to pay it, even if it's done within the reasonable time frame. They may, but an awful lot won't, because it's too difficult for them to carry an audit trail out on what's gone on. If you can't pay by scheme pays, then they can make an adjustment to your tax code to recover the extra tax throughout the following tax year, but only if the amounts are reasonable, i.e. they can recover it in a reasonable period of time. And an alternative is direct payments to HMRC, usually by direct debit in installments. They'll normally do this if it's not reasonably possible to collect everything from your tax code within 1 year, either because you don't earn enough to cover it, or because it's going to leave you unable to feed yourself, essentially. So then they'll set up a direct debit payment that might run over a period of extra years, and then maybe interest charged on that. So why would some people choose to go over the annual allowance? Now, a lot of people will spend a lot of time trying to avoid going over, but sometimes it's worth going over. There's a couple of key scenarios. I mean, there may be others, but inheritance tax, free money, usually from the employer, and high savings via salary exchange are the most common reasons. So, simply pensions are not subject to inheritance tax in most circumstances. Inheritance tax is 40% currently. So if you're a basic rate taxpayer, or your beneficiary is, because you can make pension contributions to somebody else's pension, then it can make sense to pay the 20% tax charge to move money into the pension to avoid the 40% charge later for inheritance tax. Now, if you're doing this for a child or relative or whoever you're going to pay a pension for, what you have to bear in mind is it could also become subject to potentially exempt transfers, i.e. it's seen as a gift. So even though they're going to pay the 20% charge for going over their personal allowance, if you die within 7 years, then they might still have to pay the 40% charge on top. So it could be work out badly. So you can put an insurance plan in place for that, or just make sure that it seems statistically unlikely you're going to die in that 7-year period. And it is a gamble. Inheritance tax rules could be different by the time it comes to being paid. Rates could be higher, rates could be lower. Could not exist at all. Thresholds could be different. So that was inheritance tax. The other one's free money. So if the employer has a pension scheme, which their part of each contribution is higher than the potential tax charge, then you're still better off taking the employer's free money if this money wouldn't be available to you through your salary. So if in the worst case scenario you're a 45% taxpayer, and for every £1 you pay, your employer pays £1, and it's all going to be over your allowance, it wouldn't be, because obviously you'd have your £10,000 but the maximum charge that you would be charged on that £2 going in would be 90p. So you'd still have £1.10 going in. So the cost to you is still less than the amount going in. So that £1, if you're a 45% taxpayer, you would have only received 55 pence in your pay for it. Actually less when you take national insurance into account, which is probably another 2%, depending on which end of the calculation you want to make. But let's just say you're going to get 55% pence for that £1 in the best case scenario. more likely 53. But anyway, so that £1 is worth 53 to 55 pence in your pay packet, but it ends up as £1.10 in your pension, even if you have to pay the £90 charge, 90p charge. Obviously, that scales up. And if you're in a salary exchange scheme and you avoided paying the national insurance as well, then obviously you get better off, even especially if your employer's also passing along what they're saving, then it makes these figures even better. So that's the worst case scenario. So that's the free money in NI savings. So looking like we're coming for the half hour as planned. I'll have a quick look at the question and answers box, see if there's anything in there. We have some upcoming webinars. July 31st is Buy-to-Let Realities. August the 14th is a 60% tax trap. And August 28th, there's nothing in the diary for that as of yet. So any suggestions, please free to send them over. And this QR code will take you to the page on our website where you can get the information on them. So let's have a quick look at the Q&A, but I don't think there was anything coming through. No questions in the box, which means one of two things. Either I've covered everything really well and it's very clear, or it's so confusing that nobody has any idea what's going on or has fallen asleep. But either way, thanks very much for your time. And I'll put the recording up later today once it's downloaded and everything. So if you want to go through the calculations and a bit slower, then feel free to do so. I'll attach a PDF of the slides in which I correct the typos to the email that comes out with the link to the recording. Obviously, I can't go back and change the typos in the recordings, but thank you very much for your time, and hope you enjoy the rest of your day.